Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Friday. It's July 22nd. Thank God it's Friday. I believe, no, it's not the last Friday of the month. We still have another Friday next month, third Friday of the month. It's about 7:57. Market's going to open about an hour and 33 minutes. And as you can see here, the Dow's up just a bit, about 50 points. NASDAQ is down about 40 points. Not surprising since we've been seeing some upside in the NASDAQ last couple of weeks. And the S&P is meeting us somewhere in between. Now, just to give you a little bit of an update, jobless claims yesterday was going up a little bit, just a bit on the upside. The moving average, 235, we're at 240. I mean, a little higher, but nothing really to, let's just say this. Of all the stuff that's happening in the world right now, this should be the least of our worries. The next report is something important. This is the Philadelphia Manufacturing Index. And this is giving us the manufacturing activity from Philadelphia, which is one of the big feds. And the expectation was -8 to +5.3. And when you see the number this wide, it usually means they have no idea where it's coming out. Consensus was 0.4. We came out at -12.3. That's very, very, very bad number. And June posted its first negative number since 2008. So again, we may be bottoming out here. This may be an indicator showing us that we're actually bottoming out, because a lot of the data is coming back to right now and giving us exactly what we saw in 2008, including institutional investor sentiment, which usually means we're at the bottom. Let me continue. Today, we have the PMI. This is both the manufacturing and services, and we'll find out anything over 50 is good, and they're both expected to be over 50. This comes out about 15 minutes after the market opens, not closes. And we'll see if the number is in fact. Now, what's interesting here, the range is pretty tight here, which means there's a good idea where the number is actually going to be. We're looking at manufacturing above 50 and service index above 50. Honestly, any number above 50 I will take. Anything above 50 is growth. Anything below 50 is contraction. So let's talk a little bit about global economy. We've got a lot of stuff going on in the world. Actually, before I get into global economy, why don't I talk a little bit about earnings, okay? So we've got earnings on Twitter coming out today. That's the big company. We're looking at 15 cents per share on revenue at 1.3 billion. So they're looking at about 25% less earnings per share on about 24% more revenue. Now, if you look at Twitter this morning, which we will look at right now, if I can ever find my mouse, you will see that the stock is down about 2.5%. Now, I'm not sure if the number's coming out before the opening bell or after the opening bell, but it'll be very, very interesting to see how the number is and how the stock reacts, especially in light of what we're seeing right now. Other news, you got American Express. This is a big, big company for forward-looking statement for seeing how commercial credit is doing. They're expecting $2.41. We've got some consumer staples here. You've got healthcare, HCA, big healthcare company. You've got a couple of energy companies, or just one energy company. You've got Schlumberger, another energy company. You've got Verizon. So we've got a lot of numbers. These are the expectations. If you want, you can go ahead and take a screenshot of this so you know exactly what each of these companies is expecting and how they're going to fare compared to estimates. But again, the big, big, big numbers are American Express and Twitter. Probably Twitter because of what's going on with Musk and all of that fun stuff. So again, the big ones, American Express, Twitter, obviously Verizon, and HCA Healthcare. But these are the biggest ones you need to worry about. Let's move on to global economy. Investors are still sifting through corporate report cards. We're about 12% done right now. And I'm going to be honest with you. I'm going to be very, very honest with you. The numbers so far, and again, it's very early. It's preliminary. This doesn't tell us where we're going to end up. But so far, the 12% that are out, the numbers are coming out really bad, but they're coming out better than estimates. About 60, 70% are coming out better than expectations. And if they keep coming out this way, the numbers are coming out really, really a lot better than expected. So if they keep coming out this way, we're going to be pushing this recession talk for quite some time. And the Fed may be able to tamp down this inflation, this high inflation, without putting us in a recession, which is very, very important because the bond market's already assimilating 3/4 of a point and it's just humming along. So I think most of the downside is priced into the long bond. But let's talk more about this. And I'll have more of a report on Ask the Pros today and on my VIP room if you're in there. Don't miss out on that session. I'll give you an update on earnings. This is a hot week, and next week is even a hotter week. So Federal Reserve is set to raise rates next week, 4th time this year. It's already priced into the market. Preliminary reading on factory activity in Japan shows output and new orders contracting to their worst level in months. Hey, they want to make it painful before things get better. July's Purchasing Managers Index suggested manufacturing is slowing as demand weakens, while the latest COVID is starting to hit services index. That's bad. PMIs in Europe likewise showed sign of contraction as the region contends with the resurgence of COVID, the war in Ukraine, and disruption of gas supplies in Russia. They're just getting it all. Japan reported Friday that inflation rose at a slower pace in June, and this is important, with food prices growing 6.5% year over year compared to 12.3% in May. So that means we may be cooling off. Energy increase costs falling to 16.5 from 20. Core inflation, excluding energy and food, rose. So they're still rising in Japan, but in the US, core inflation is going down. And I think the headline number is going to go down too, because food and energy prices in the US have been going down the last couple of months. We know that. We've seen the charts. Much of the focus this week has been Europe. European central banks opted, as expected, to raise its key interest rates Thursday, ending a year-long experiment with negative interest rates. That's not good. That negative interest rates didn't do anyone any favors. It was the first increase in 11 years. Now, a key pipeline carrying Russian natural gas into the region reopened, though 40% capacity as worries persisted over Moscow may restrict supplies to punish allies in Ukraine. And in Italy, Mario Draghi resigned after his ruling fell apart. That adds to more uncertainty in Europe with inflation, bond market, and Ukraine. So there's a lot of stuff going on. Now, let's look at U.S. stocks, because this is getting fun. So we're breaking out on the Russell 2000. We need to break above. Let me just show you something. We need to break above this level, this key level right here, 191. That's when the CPI 8.6 came out and just destroyed the market, took us to all-time lows. But we're recovering pretty good from here. And I like what I'm seeing on the Russell. On the Dow Jones, let's see if we're near that 32,000 level. No, we're still we're at 32,000. Sorry. We're at 32,000. We are above resistance. I told you guys that if we break above here, there's a good chance we'll continue. It'll be really interesting to see if we can make it to this level. I think the biggest factor over the next couple of weeks is to see if we can get past or above or at that CPI level. Now, a few major sectors like healthcare, for example. Let me show you. One of the reasons why I like healthcare, it's almost at that level. You see that? It's almost at that level. Nice little ascending triangle going on over here. Oops. Almost at that level. Nice little potential breakout here. But as you can see here, nice ascending triangle. And also, consumer staples have been near that level. They've been holding on. They never went down. They never went up. They're kind of just holding on. But if you look at technology, look at how it's been breaking up. Technology's almost there. Almost there. Look at consumer consumer discretionary. Literally, we're there. So there's the key here right now is, are we going to break higher above these levels, or are we going to fall back into the range? Because we're now back up here. In all honesty, and let me show you the sectors. In all honesty, here's the sectors right now visually. In all honesty, I think we're going to kind of fall back into the range. I don't think we're going to get past this. It'll be very interesting to see if we do on the SPY. If we get past that on the SPY, there's a good chance we'll get past that. But we're not there yet. The SPY still has a while to go. That level on the SPY is about 41 416, 417. So keep your eye on that level. On the QQQ, that level is, and we're getting close to that level. That level is right here, 313. If we can get just a little higher, we're 307, 308. We went as high as 307. Just a little bit more, we're at that level. So, and I think we'll get there. But the question is going to be whether we bounce off of these levels or come back down. And that's going to be the next factor. And earnings are going to determine that. If earnings are better than expected, if they continue coming better than expected, then there's a good chance we'll get a rally on the spec stocks, which means consolidation for the defensive stocks like consumer staples and healthcare. If, on the other hand, we start cooling off again on the speculative stocks like technology and communication and consumer discretionary, notice, remember I told you we're going choppy, we're going to go up here? This is the resistance level here. On communications, it's at 63. On consumer discretionary, it's at 166, 165. We're already at 163. So we're really getting up there. The question is, are we going to get past this level or not? It's very hard to say right now. And the next couple of days will tell us if that's the case. Now, this week has been a pretty cool week. We had a chance to close down NVIDIA. We held it for 7 days. We made about 37%. We got out like right around here. Got out on the, let's see here. We got out on the 18th, right here, right there. Got in right here, got out right there. Could have kept on for a few more days, but that's okay. Same thing with AMD. Got into AMD. We held it for 19 days, got out at 23%, got out on the same day on the 18th, right here actually. Went up a little more, but we've been picking these bottoms pretty good here. And it's the first time I'm starting to look at bottoms. But I'm going to tell you folks, markets are changing. Right now, the biggest factor we want to take a look at is earnings, and if earnings are going to beat expectations, and expectations are real low. And I'm going to give you an update again. If you look at the major sectors, they're going through some rotation right now. Here, for example, oops, not working for some reason. Let's see if we can get it working here. Yeah, if you look at the major sectors right now, energy's leading and cumulatively keeps going back and forth. Healthcare, I would stick with healthcare and consumer staples right now. Those stocks are doing well. In the short term, you've got consumer discretionary, technology, and communication services. I would be cautious right now. They're a little bit overbought, and I would still stay with healthcare because that has more defensive aspect. And the last time I checked, markets are still very, very, very defensive. Now, before I let you go for the weekend, folks, I got something important for you. For the last 6 months, I've been working day and night to develop a brand new way to trade. It revolves around 5 basic patterns with the ability to tip us off on some big, fast moves on stocks. So far, we've had 9 for 9 real trades since I started using the trading, real trade signals since I started using the strategy. Of course, not every trade is going to be a winner, but I'm extremely impressed. And I have a really good feel about the strategy because I've back tested it to death. And it's performing during good markets, bad markets, and it's been on a roll in a crazy market. And I have every intention to try and keep the streak alive as long as possible. So I want to invite you to watch a video that I put together where I teach you my newest strategy, Pattern Trader. Plus, in the video, I'll give you 3, not 1, not 2, 3 brand new trade ideas that are on my Pattern Trader hit list completely for free. So you can educate yourself, see how it works, check out the profit factor, look at the trades, get the nitty gritty for yourself. Follow the link below, check it out. It's not going to be around very long. We're gonna take it off because people have been really hot and heavy about it, and it's been just selling out. So again, follow the link below. If you're watching on the YouTube channel, it's in the descriptor of the video, or see the link below this video. Check it out. I'm hoping to have some more winners for you today or maybe next week. Bye, guys. See you later and have a great, great day. Bye.